Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. In this video, we're going to say challenge accepted, and we're going to prove with the numbers that paying incremental tax on Roth conversions using outside funds will result in more money landing in your pocketbook. And this challenge comes from one of your fellow members of the Personal Tax Planning Template Program, and it says, Question: I've come across numerous articles and videos stating that it's obvious paying Roth conversion taxes using outside funds is smarter than using withholding, basically withholding on the distribution such that less ends up inside of the Roth IRA. And here's the key, but no one shows any calculations to back it up. Of course they don't, my friend. They do a lot of talking and they do a lot of squawking. But this right here is the reason why so many folks come test their knowledge with me, because here at Number Crunch Nerds, we prove it with the numbers each and every time. So let's jump into it. And by the way, if you enjoy this video, please like and subscribe, and let me know in the comments what's going on in your 2026 tax planning situation. Okay, so here we are inside of the Roth conversion benefit of paying the incremental tax with outside funds calculator. Let's start with a lay of the land. So right here we have our pre-tax accounts. This will be the tax payment analysis that will look at the difference between using outside funds versus doing withholding on your distributions. Right here, we're going to have our after-tax accounts. And then finally over here will be our regular brokerage accounts. And these accounts right here will represent the source of outside funds used to cover the incremental tax on the conversion once we get to that part of the analysis. So coming back over here, starting with the pre-tax accounts, we're going to assume in this example that the starting balance on a pre-tax basis is $1 million. We are going to apply a 5% annual rate of return, which in year number one will result in a return of $50,000. The next column is the balance of the account after the return, and then we have our distribution, or in this case a Roth IRA conversion. We're going to do $40,000 annually for the life of the example. So if we start with the balance after the annual return of $1,050,000 and we subtract the $40,000 conversion, the ending balance at the end of year number one is $1,010,000. Now coming over here to the tax payment analysis, I am going to change, for example number one, the usage of the outside funds to be 0%. By using 0% for the outside funds, you can see that the amount applied to withholding is going to change to 100%. Obviously, it will be one or the other or a combination of both that is used to cover the incremental tax. And here is how the calculation will work. This is the annual conversion amount. This right here is the incremental tax on this amount of conversion determined at a marginal rate of 24%. That is the marginal rate we will be using throughout this entire example. Now, in the case where withholding is 100%, in other words, we are applying no outside funds to the incremental tax, then $9,600 in this example will come out of the total conversion amount, such that the amount which ultimately ends up in the Roth IRA is $30,400. Okay, now coming over here to our after-tax accounts, we will assume that the starting balance of the Roth IRA in this example is 0. Therefore, in year number one, there is no return, and the only thing going into the account will be the conversion itself, in this case $30,400. Thus, the ending balance in the Roth IRA accounts at the end of year number one is $30,400. Okay, now coming over here to the fully taxable brokerage accounts, we're going to assume for this example that the starting balance is $200,000, and we're going to assume a 5% rate of return, which takes the form of interest interest and dividends. In other words, in this example, the source of this return is income that will be taxed on an annual basis. For simplicity, we are going to put aside market appreciation and assume this is strictly an income-generating portfolio. Therefore, at a 5% rate of return, the amount of income generated in year one is $10,000 on a pre-tax basis, and it is $7,600 on an after-tax basis at the marginal rate of 24%, which is what we are using throughout this example. That results in a balance before considering any distributions of $207,600, and in this case, we're only going to consider distributions for the purposes of paying the incremental tax on the Roth conversion. In this first example, since back over here we have marked 0% for the usage of outside funds, the annual distribution at the moment will be $0. However, later when we adjust this to be an amount that is greater than 0%, you will see this column of distributions increase accordingly. Okay, now for those of you following the channel, you are familiar with how the remaining 29 years in the example will work. Starting right here, the balance at the end of year one will become the balance at the beginning of year two. We will apply our 5% rate of return. We will complete our $40,000 annual conversion. Coming over here, $9,600 will be withheld, leaving $30,400 to go into the Roth for year two. Now over here in the Roth, the ending balance of year one becomes the beginning balance of year two. We apply our rate of return. We get our balance after the return. We add the additional $30,400 of conversion, resulting in an ending balance for year two of $62,320. And then coming over here to our fully taxable brokerage accounts, the ending balance for year one becomes the beginning balance for year two. We apply the rate of return that is generating income. We apply a 24% tax rate to that income. We get the after-tax balance after this return right here. There is currently no distribution in example one, and the ending balance in the fully taxable brokerage is $215,489 at the end of year two. And that process continues for all years until we get down here to the end, year number 30 of this example. So now let's go over the results for example one. At the end of the 30th year, we have $1.6 million in the pre-tax accounts. We are going to assume that all of that will come out at the 24% marginal rate, either in the form of RMDs in your hands or in the form of RMDs in the hands of your beneficiaries, resulting in an after-tax value of $1.2 million. Now over here in the Roth accounts, at the end of year 30, we have $2,019,000. And then finally over here at the end of the 30th year in the fully taxable brokerage, we have $612,000. Now coming down here to this summary table, which shows the after-tax value of the combination of all three accounts, depending on the percentage of outside funds used. So if I double click on this cell right here, you can see we are summing up the after-tax value of the pre-tax accounts, the after-tax accounts, and the fully taxable brokerage accounts. So in the scenario where we used $0 of outside funds to cover the incremental tax on the conversions, the total after-tax value obtained from the sum of all three accounts is $3,896,957. Okay, now what if I go up here to the outside funds toggle and I put in 50%? In other words, now we are going to withhold 50% of the incremental tax, and then we will pay the other 50% with outside funds. And now you can see that the amount of outside funds used annually, in this case $4,800, that is now coming out of the fully taxable brokerage over here. This is where the outside funds comes from. And so based on that setup, coming down here and looking at this summation again, the total after-tax value derived from the sum of all three accounts, in the case where we're doing only 50% withholding and paying 50% of the incremental tax with outside funds, is $3,955,476. Okay, let's go up here and take it a step further. I am going to change the amount of outside funds used to be 100%. Now the amount of outside funds being used is equal to the incremental tax in all years because the amount of withholding is now 0. And again, you can see that the distribution from the regular brokerage account, which is the source of the outside funds that we are using, is now updated to be $9,600 annually. And so once again, if we go down here to the summary and we add up all three of these after-tax results, we can see that the total after-tax value obtained by covering 100% of the incremental tax on the Roth conversions using outside funds is going to be $4,013,994. So to compare the difference right here, the additional after-tax value obtained from 100% usage of outside funds versus 0% usage is going to be $117,037, and you can see that is the difference between this number right here and the first number we calculated right there. Now I want to take things a step further because yes, this calculation proves that using outside funds to cover the incremental tax will ultimately put more after-tax cash flow in your pocket than doing withholding on the conversions. But now the question is why? Why does it result in more after-tax cash flow in your pocket? At Number Crunch Nerds, we leave no stone unturned. It is not good enough for us just to see that this works. We want to know, why does this work? What is occurring to cause this to be the case? And to answer that question, let's think about it like this. If you take a distribution of $9,600 from a fully taxable brokerage account and you use that money to cover the incremental tax on a Roth conversion, what you are effectively doing is allowing another $9,600 to make it into the Roth IRA. Just to make sure that's clear, let's put this back to 0% on the outside funds. In that case, withholding becomes equal to 100%, and if we withhold $9,600, then only $30,400 is making it into the Roth IRA. Now let's take that thought process one step further. Effectively, what you are really doing is you are transferring this $9,600 from a fully taxable account into an account where the income will grow on a tax-free basis. Now let's make a very clear distinction between the words that I just used. Because if you say to your financial advisor, hey, I'm going to transfer $9,600 from my regular brokerage account into my Roth IRA, they're going to think you're crazy. Because the actual mechanics here are you are taking a distribution from a fully taxable brokerage account and you are using the money to pay the tax on a Roth IRA conversion, effectively allowing more of the converted money to actually end up in the Roth IRA. That's what's actually happening. But in effect, even though these are not the actual mechanics of the transaction, you are essentially taking $9,600 out of a fully taxable account and you're putting it in an after-tax account. Therefore, that $9,600 will grow at 5% on an after-tax basis. The first year's $9,600 will grow for 29 years. The second year's $9,600 will grow for 28 years. The third year's $9,600 will grow for 27 years, and so on. So now, with that in mind, let's go over here to the paying with outside funds funds benefit reconciliation. Right here, this is the amount of incremental tax that you paid in year one using the outside funds, which came from a distribution from a fully taxable account. By doing that, you allowed an additional $9,600 to go into an after-tax account. Therefore, if we take that $9,600 and we multiply it by the gross rate of return that we are using in this example, 5%, and then we compound that growth for 29 years. The result right here in this cell, if I click on this formula, is the original amount of extra money moved from a taxable situation into an after-tax situation, multiplied by 1 plus the gross rate of return raised to the number of years for which this is compounded. That right there is the future value of the tax savings at the gross rate of return of 5%. Now over here in the next cell, I am going to do the exact same calculation. However, this time I am going to use the net rate of return, which is equal to the gross rate of return right here multiplied by 1 minus the marginal rate of 24%. Then I am going to use that net rate of return to calculate future value again in this cell. Once again, this is simply the annual amount of $9,600 multiplied by the net rate of return, in other words, the after-tax rate of return, and then compounded for the number of years relevant to each row. And so what this is saying is that the value of $9,600 sitting in a Roth IRA, earning a 5% gross rate of return but not being subject to an annual tax, is worth $39,515 when compounded for 29 years. It's worth $37,633 when compounded for 28 years. It's worth $35,841 when compounded for 27 years. And over here, these are the future values of the same calculation, except for the fact that if the $9,600 was sitting in a fully taxable brokerage account, the net rate of return would only be 3.8%. And then finally, right here in the net benefit column, I am simply going to take the difference between the future value of the money sitting in the Roth IRA versus the future value of the money sitting in the fully taxable brokerage account. And once we determine the net benefit for each year within the calculation and we sum them up, you can see that the grand total difference is $117,037, which is the exact same $117,037 that we calculated right over here. So to summarize everything that we just went over, why does paying the incremental tax on Roth conversions with outside funds result in more after-tax cash flow in your family's pocket? And the answer is because for every dollar that you can get out of a fully taxable situation, in other words, where the earnings on that money is taxed on an annual basis, and you can put that money into an after-tax situation and allow that money to grow at the same rate but without being subject to tax, then what you have achieved is a tax savings on the cumulative future value of all of those dollars that you used in that situation. By the way, I have just uploaded this outside funds analysis calculator to the members area for the personal tax planning template program. So for members, feel free to log in at your convenience and check that out. And if you are not already a member of the program, summer 2026 planning is going in full effect right now. We are getting ready to execute those Roth IRA conversions later in 2026. So if you've been procrastinating and wishing and wanting and thinking about whether or not you should complete Roth IRA conversions as you prepare for retirement, there is no better time to hop into the class, binge watch those extensive training videos, and get ready to execute your conversion before 2026 comes to an end. You can find a link to join the program in the description below this video on YouTube, and I look forward to seeing you inside the class.